We do these presentations for educational purposes. I think we always have a count. We have 112 or 115 people eating tonight, and 75 to 80 of you are already clients of mine. I like to stress that because that's the purpose of these. When we started doing these, we started doing them because we recognized that cognitive, that C function that's trying to compete with our instincts, our perceptions, our emotions in the media needed to be bolstered. So we started doing these events, and it's not a sales pitch we're throwing out here. It's something new that we bring every quarter. This Bubbles presentation that we're going to talk about, I've not given it before. We find articles, we find topics of interest, we listen to the news, we kind of figure out what's getting in your head, and currently they've been talking about bubbles a lot, right, in the news media. So we try to bring something that's going to be relevant. If you wanted to come back every quarter, you'd be welcome, and you'd hear something new most of the time. So this is educational stuff. It's here for you to increase that C function in the equation so that you can beat those bullies and punch them in the nose. So we're going to go through this. It's called Bursting the Bubbles. It'll be a little shorter. And again, just flag your wait staff down, get another coffee as you need it, get up and get dessert. There's a lot of that left, or more steak, whatever you want. Please, you won't offend me by doing that. All right, bursting the bubbles. Bubbles. I sent out a lot of emails about this. Are we in a bubble currently? I'll answer that. Bubbles are any economic trade that are in high volumes at prices that are considerably higher than intrinsic values. Now, what's the intrinsic value of a company? What's the intrinsic value of Apple Corporation? We know that its stock is trading at highs that make it one of the top 1 or 2 or 3 companies from a size standpoint in the world, $500 billion. But what's its intrinsic value? And is Apple trading at higher than its intrinsic value? Intrinsic value takes into consideration all of these components: the sales component, the customer base component, the product component, patents, everything, the book value, the value of its real estate and anything that it owns. The intrinsic value is a value of the company that doesn't necessarily equal their stock price at any given point. And you can know that stock prices elevate very quickly of Apple, for example. Did Apple actually do something that necessarily increased its value? We're going to take a look at that. What is that intrinsic value, and how can you notice a separation between those two? Sometimes referred to as a speculative bubble. They come in all shapes and sizes, lots of different weights. What we know about bubbles, though, is that as prices become inflated, they always burst, right? Bubbles burst. They don't last forever, and when you have one, you'll see it burst. What we've just experienced in the U.S. large company market, 35% growth in U.S. large companies. Now, is that a bubble as far as U.S. companies goes? One of the emails that I sent out here essentially made the case that, yes, your portfolio could have a bubble of that asset class in it. And Liz, maybe this is getting real tinny. I'm going to maybe turn this down a little bit, or bring it down. Is that a little better? Have her turn it down if you can find her, because this is a little loud. It'd be great. I think it's up to 11. You've seen that movie? It's a good one. Maybe 3 of you get that joke. That's okay. I'll tell you all later. I've lost my train of thought. Okay, so in a portfolio, if you should have 7% large U.S. companies in your portfolio, and large U.S. companies went up more than everything else, you might have 8 or 9% of large U.S. companies in your portfolio. That would be a bubble, right? It's the reason why on January 9 or 10, we rebalanced out of large U.S. Now, we didn't rebalance out of large U.S. because we saw last week's downfall coming, right? We simply rebalanced because we saw that the large U.S. was more than 2% out of scope. So you can know that when we say in your growth fund, or in your moderate fund, or in your conservative fund or aggressive fund, if your U.S. large company sector should be 6.35% of your total portfolio and it becomes 8.4%, we're going to sell it off and redistribute it into the asset classes that did relatively less well. That's called rebalancing. That's the answer to bubbles. So in that case, U.S. large companies were experiencing a bubble inside of our portfolios, and we corrected that. But are U.S. companies right now a bubble with respect to themselves? Are they trading at much higher than their intrinsic values? And the email that I sent out made the case that it wasn't. And at the end, I'll give a little bit more about that. That U.S. companies are, compared to their book value, not nearly as high as they have been in the past, not compared to one aspect of their intrinsic value. But when there is a bubble, we have to be careful because bubbles do always pop. We found this article on businesspundit.com, and we thought it would make a good base. So I'll go through these relatively quickly. The 10 most bizarre economic bubbles in history, and then we've added a few that'll make you laugh at the end. This one hits close to home. This is tulip mania. You all know where I'm from now, right? The Netherlands, my family. In 1593, tulips were brought from Turkey, where it was really a good and natural climate for them, into Holland. And the Dutch instantly fell in love with these flowers. And by the latter months of 1636, so 4 decades later, the Dutch figured out how to pull them. So in Turkey, you can just leave them in the ground and everything happens the way it needs to. In the Netherlands, the climate is such that you really have to pull them out every year and dry them, and then you can sell some and split them in half when they split and resell them. When we got to Michigan, when my parents moved to Michigan, my grandfather, my mom's dad, had a tulip farm in our backyard, and he still loved to do this. He was in his late 70s, and he still grew tulips. We had these big, huge rows of tulips in our backyard, just like the Netherlands, right in my backyard. I probably didn't appreciate it growing up because it was there when I was a kid, but I kind of want to do the same thing. But by 1936, these tulips became so valuable to the Dutch that they were worth more than an Amsterdam house. The Dutch started trading their homes for tulip bulbs. It was said that the black bulb, the black tulip bulb, could be worth in today's dollars $26,000. Now, try this one out. You come home from a hard day's work. Honey, I sold the house. What'd you get for it? You're looking at it right here. It's a tulip bulb, and you've got this dirty old little mangy bulb, right? This is what they would sell a house for, these little cottages. They're not large houses. They weren't like the houses we have now. Some of them, even today, don't have running water. They go to a neighboring building for that. Very, very small, but they would trade their houses for these tulips. These tulips became very, very valuable, but the overinflated prices couldn't last, and within weeks the prices fell to 1/100th of their value. This is the first bubble that we talk about. Everyone knows what, you think of the Dutch, right? The Dutch can stretch a dollar. My grandma, Beppa, we talk about if you have a light cup of tea, we call it Beppa tea. She is known to have gotten through the whole war on one tea bag. That's how she does it. So even today, if you have a light cup of tea in my house, anybody will know that that's Beppa tea, and you can get through the war on a tea bag if you stretch that thing far enough. But there's a reason they had to do that, right? Because they lost everything with trading tulips emotionally. So the Dutch didn't always have that propensity. But number 9, the South Sea bubble. This is where the term bubble itself came from. It originated with inflated stock prices from the South Sea Company, a British joint stock company granted exclusive rights to trade with South America in the 1720 era in return for financing the British government war debt. It's a time of lavish opulence. It's a nice word, opulence in Britain. Are we in opulence now? Maybe not lavish. Maybe not opulent either. Many wealthy speculators were desperate to invest in a company that wildly promised astronomical returns. They were trading woolen fleece for piles of gems and gold. Shares in the company quickly reached 10 times their original value. But when the bubble burst, many of the country's elite were left destitute. Because what happens with bubbles? Who gets in on the very beginning of the bubbles, right? Who guesses the person who gets 6 heads in a row right at, maybe a few of us, right? We all generally buy after it's gone up considerably, and then when it crashes, almost everybody who bought lost. Sir Isaac Newton was among the most notable losers. He lost 20 pounds, or 20,000 pounds in the stock trade. Isaac Newton was not a dumb guy. Thermodynamics, I think, was his gig. He created at least 3 laws of thermodynamics. He invented calculus, I think, in order to be able to talk with the simpletons around him, like you and I, about what he was inventing, right? And what he was coming up with. So he's not good at calculus. He came up with calculus. So he's a pretty smart guy. Some of us remember the calculus classroom and where that was, right? We know where all those kids were. Well, this is where Isaac Newton lived mentally. He said, I can calculate the movement of stars, but not the madness of men. He realized 2 things. I can't predict the future, and I'm not going to try. And stock markets are not predictable. They're random enough. I can't figure them out. And I think we can learn as much from the bubble itself than the victims like in the last presentation. The rhodium bubble in 2008 saw prices of this rare chemical increase from $500 an ounce to $9,500 an ounce in just 18 months. And then within 6 months of that period, it went down to back to 1,000. Now, had you been Rip Van Winkle and you owned it at 500 and then you woke up and it was 1,000, you thought, whoo, great, it doubled, right? And you missed the whole debacle, right? You missed the whole big, huge ride. But most of you would have bought it at about 7,000 or 8,000. Some of you would have bought it right at the 9,500. That probably would have been me if I was trying to guess, which is why I don't try to guess. And much money was lost. Anyone who bought at 95 and it went down to 1,000 lost 90% of their money. And that was the commodities bubble we had shown in the other slide. Nobody's quite sure what sparked this buying frenzy, but seems to have been a combination of the American car industry, bullish markets in metals, and then at least one rogue investor that got the deal started. Railway mania. This was about contracts that were authorized and never built. So in the 1840s, peaking in 46, 9,500 miles of railway were authorized, and I think over a third of those were never actually built. And so on these authorized railways, authorized by the government and by the suppliers, these railways were supposed to be built. And so what we did as investors is that we started buying the shares of these railway companies. More money poured in. What was unique about this period is that there was a larger middle class than had ever been around and assembled. And they had extra income that they wanted to invest, and they wanted to get a return on that income. And so they, right fresh from their industrial revolution and their new paycheck, they invested, stock prices skyrocketed, and these contracts never came to fruition. It turned out that railways are harder to build than just saying, hey, I want to go this direction, and we're just going to build a railway. Well, there's theft, there's mountains, there's dynamite, there's all kinds of disease, and the collapse was unavoidable after a while. Middle class families lost their life savings as a result. This sounds like something we've been through before. We can sometimes look back at this and say, come on, people, let's think a little bit. But it kind of sounds a little like the dot-com era. We're going to get to that one next, or in a few minutes. Romanian property bubble. Romania is said to have the highest house price to income ratio in the world. Not sure this house is part of that equation or not. I'm not sure what the person owns that owns this one. The price of an old communist era apartment increased by 1,000% between 2002 and 2007, leaving apartment prices in Romania's capital city rivaling that of Paris or London. Mississippi bubble. John Law in the 1700s early established the, I'm going to get this wrong, Banque Générale Privée. Any French speakers? How did I do? No thumbs up or thumbs down. I'll take that as good. And a year later, the Mississippi Company, two companies, which ended up with a complete monopoly on France's colonial trade, not to mention responsibilities for collecting French taxes and for minting money. Now, this whole group of people assembled there that you can see, this is said to be a picture of people who were looking for their money back on these bad notes that they had in their hands. The company's share price skyrocketed from 500 to 18,000 livres per share. Popularity of the company shares was so great that they prompted the need for more paper banknotes, which the Mississippi Company was all too happy to oblige and write. The bubble finally burst when it became clear that the number of notes being issued wasn't backed by the coinage the company held anymore. That sounds a little familiar as well. It sounds a little bit like a Ponzi scheme to me. Florida land boom. So you're in the middle of New York in the wintertime, and up on the Jumbotron, back at the day was a big, huge piece of plywood probably. It says, it's June in Miami. Well, that sounds pretty good, right? So what happened is construction supplies started to head south because everyone was going to build in Miami in the early 1900s, and these supplies clogged the rail system. This is a comedy of errors, but it still happened. It clogged the rail system, and the companies soon banned the use, rail companies soon banned the use of their rails for the purpose of bringing construction equipment down to Florida. Then, in 26, a schooner sank, blocking the second way you could get down to Miami, through the harbor. And then finally, the Miami hurricane hit and just drove the nail in the coffin, and all the investments that were made in the construction companies to develop this land for the northerners to go buy down south. Now, were they wrong about the fact that everyone in the north was going to want to buy a place down in Florida? No, they weren't wrong about that necessarily, but the bubble that was created in the frenzy certainly wasn't something that you wanted to jump on. Three more. Poseidon bubble. In the 1960s, nickel was in high demand. Prices were greater than ever, thanks to the Vietnam War, but industrial action against the world's major supplier, Inco, led to a supply shortfall. Australian mining company Poseidon NL discovered a potentially lucrative nickel mine in Australia. And then again, here this sounds a lot like the dot-com thing again. Their share prices grew dramatically, along with investments in other mining companies and mining in general. Numerous of these new mining companies, they didn't have contracts, so they didn't have leases on mines. And yet, because mining was in, everyone jumped in, and there were stock prices rising on mining companies that didn't even have a lease on a mine. And investors lost money on those. Negative press ensued, and share prices plummeted on all of these types of companies. And this is the one we, in recent memory, probably understand and remember the most, the dot-com bubble, most well-known. A novelty and difficulty in valuing these dot-com companies, right? And enthusiasm about the internet. Not hard to understand. The bubble grew to bursting points between 95 and 2001. Thousands of dollars of investments flew into these dot-coms. Risky policies of growth over profit, believing that if they could just sign up enough customers, the profits would follow in time. And the business models were never tried or tested in any of these. They were all speculative, and we know what happened. The NASDAQ we saw, well, I think we're going to say, no, the NASDAQ we saw. I saw it earlier today when I was looking at it in preparation for tonight. You haven't yet. Here it is. The NASDAQ was the market for this type of stock, this tech stock, and it went from 2,000 to 4,500, 5,000 by the early 2000s. And it plummeted all the way below where it had gone before. So it was back down to about 700 by the end of the bubble bursting. What was so troubling along the way was that the internet was said to have been this no-fail thing for investors, that we would sell, as investors, other parts of our portfolio to get on this wagon. So it wasn't just that this portion of our portfolios became larger. It was that this investment became a greater part of our portfolios because we allowed it to. We wanted it to. We wanted this to continue. We tend to see patterns, and we look at these patterns like Harry Dent did, and we say, hey, what if this keeps going, right? And we just pile it on. The last one, the uranium bubble in the 70s, hit spot prices of around $110 per pound. It dropped to below $20, which is where it stayed until 2005. And then a perception of future nuclear energy demand from emerging economies, reactor lifetime extensions in the West, low inventories at the time, led to a swift increase from 05 to 07. And uranium mining exploration company stocks soared, and then a sharp post-2007 fall caused the mining and exploration companies to go bust because many of them owned this element, this metal, having purchased it at a price that they could not use it and sell it in a product for afterwards. So they didn't have a model that worked for them anymore based on their inventory. So other less bizarre economic bubbles, the Roaring '20s, Japanese asset price bubble, estate bubbles, my personal favorite. I remember the Beanie Baby bubble. It's not really a bubble. I put it on there as a joke. Beanie Babies in 1993. You can still buy a Beanie Baby if you get the, what did they say, the original Princess Diana Beanie Baby. Go to eBay right now, and you can buy one for $350,000. Pretty crazy. If it's in good condition, if it's a first-year model, Princess Diana Beanie Baby, $350 grand.
Remember the ostrich boom where everybody was going to be eating ostrich meat about 1980s?
Ostrich boom? Anybody remember the ostrich boom in the 1980s? I don't.
I went out to investigate an ostrich farm, and they were eagles, not the African ostrich.
Well, don't get caught up in the emu. They look a lot like ostriches from what I understand. And count the toes, is that what you're saying? Okay, well, I think we've all gotten it. I can just end right on that because that is, if that ever happens, you know, count the toes. How many toes does an ostrich have?
I forget which one has 3 or which one has 2.
Well, we're going to want to get that. I'll bring it to you next quarter, okay? Meet me back here next quarter. We'll get it back. Thanks, John. Bubbles happen. That's the point. How to avoid becoming a bubble victim is the point of today's second talk. Because bubbles, again, are real, and they affect our real net worth. They affect our real ability to pull money out of our investment accounts. They affect our real ability to buy a house or to afford the kind of lifestyle that we're planning to afford. I was thinking about this and I wondered, enough of you probably went through the dot-com bubble in early 2000s. I'm going to show you slides, and this does frustrate people who've not seen it before. But the dot-com bubble, for a diversified portfolio, a growth portfolio, did not have to lose a dollar until 2002, where it lost about 8% total. So had you been diversified through the whole period, you would have had positive returns from 99 to 2000, 2001. 2002, you'd have lost 8%. 2003, it would have all been back again halfway through the year. Now, how much money would be in your current portfolio today had you been diversified through the dot-com bubble, rather than having not been diversified or just been in large U.S. companies? Most of you know that you were in large U.S. companies because you lost 20, 30, some of you 50% during that period of time, and it didn't have to happen. And that's where this becomes important. If we can avoid bubbles for you up-and-coming 20, 30-year-olds who are saving, you can have fewer down years, more up years, and have a much greater return over the long term. If you're in retirement and you can avoid bubbles, you can have a steadier, greater, longer stream of income with lesser invested dollars. These are very important questions, and avoiding bubbles is huge. There are 4 things you need to know to avoid a bubble. Number 1, develop a healthy skepticism of ever adding or loading up on something that has a high recent performance. A healthy skepticism of ever loading up on something that has a high recent performance. I can't tell you how often we were asked to put long-term bonds in our portfolios in the early part of the 2000s. After the dot-com bubble was gone, long-term bonds had been producing very good returns because mortgages were being sold like crazy. And it was being sold on the story that long-term bonds always pay. And they always pay for 2 reasons. Because number 1, they're backed by mortgages. And even though mortgages don't always get paid off, most of the time they do. And when they don't, all the bank needs to do is foreclose on the home, and homes always go up in value. Put long-term bonds in your portfolio because they give a better return than short. And recently they had been doing very, very well. Well, the mutual fund organization that we work with did not buy long-term bonds, and as a result did not get sucked into that. But that was a recent uptick in a particular asset class that many were piling onto because of recent benefits to investors. This is one that we actually did put into the investment mix. This is emerging markets from 94 to 95. It's a period that emerging markets did not do very well. The reason we have a graph for it is because this was the live period that existed before we added them to our portfolios. So did we pass the first test? Yeah. We didn't put an asset class in our mix of assets after it had just run up. We actually did it after a 2-year period of live results that it actually went down. But what we had done is we had studied the 35 years previous to this, or 30 years previous to this, and knew that this was an asset class that did 2 things. It produced a premium, it gave good returns over the norm, and it had good diversification benefits, which we'll go into in a minute. It acted differently than other asset classes, so it offset certain things. All right, but this was the performance from 94 and 95, and it was at this point that we felt like we had enough information to say, let's add it in, so we added it in. So we passed the first test. We didn't add in an asset class that had just blown through the roof. This is when we put it in. It had gone down 12% over those 2 years. And this is what it did since. It wasn't super exciting for the next 4 or 5, 3 or 4 years, yeah, 4 or 5 years. But it did turn $10,000 into $36,000 over a 15-year period after we put it in. And more importantly than what it actually did, because that's not something we could have predicted perfectly either, it had a return premium and had correlating benefits. So we passed the test in adding an asset class, not simply because it had a recent increase in market. We didn't do what so many did during that same period, during this period of 94 to 99, when the US large company market just seemed to be going through the roof. This is what Harry Dent wrote books about and said we're going to have a Dow of 35,000. Sure enough, if you draw a straight line from here all the way straight through the roof, it would go to 35,000 by 2007. Small companies in the US didn't do as well, that red line, and international companies, the green line, was really lackluster during that time. And many investors slowly dumped their international portfolios and added into the blue and the red, and then when this started to happen, they dumped the red and added into the blue, and they were all in by the end of this run. And These were the returns that kind of got them there. The international growth returns, 6.8, 13, 4, 4. It didn't compare even a little bit to the S&P 500 and what it was doing. And at the water cooler, if someone's getting 30% and you're diversified and getting 25 or 20, you don't feel very good about yourself. And everybody's making money, and the herd is doing it. So you slowly drop international. And then here, you go down a little in the small company fund, and you say, you know, heck with this, I'm going to get with the program here, right? And had you remained diversified, you would have had this diversifier in your portfolio during this entire tech crash. You would have had the small company fund in your portfolio. And this little period of time in 2002 would have caused you in a well-diversified portfolio to lose 7% in a growth fund, maybe 15% in an aggressive fund. But most people didn't have the diversifier because it wasn't exciting to own the diversifier here, and so we dropped it. So two, second reason or second way to avoid a bubble, insist on academic proof that asset categories give both things. We've talked about it already. Premiums, expected market premiums, and diversification benefits. Okay? The first is the market factor. If you're in the stock market, it's not my arm. Okay, just kind of walk slowly. If you're in the stock market as opposed to the bond market, here in the tall blue, you would get a 7.78% rate of return over T-bills. So this graph does not say that the universe of stocks does 7.78%. What it says is it does 7.78% over average inflation or T-bills. Okay, so it's the premium that stocks give over guaranteed investments. That's what we're looking for, is premiums. Because if we're going to add risk to your portfolio, we better know that we're going to get paid for it. We can all take risks. We could drive down the highway with our eyes closed, and that's a risk, but it doesn't pay, right? But this pays because over very long periods of time, rather than investing in CDs, if you invest in stocks, you have some risk involved, but again, it pays almost 8% over that. Now you add the size factor. Small companies pay 3.15% premium over this number, the total universe of companies. So now we have a small company premium. And the price factor, this high book to market, these value companies, these low price companies, they pay nearly a 5% premium over that number. Remember that asset category that did 14.75%, those microcaps, small value? That's all three. It's the market of small companies that are value companies, and it has averaged actually over the last, since 1927, what's that, 80-something years, it's averaged nearly 15%. These are premiums. These are premiums we can bank on to be there over long periods of time. They're not premiums we can guess when, and we don't know how they're going to act one versus another. They don't always act dissimilarly. Sometimes they go down the hill together, like in 2008. But it's very often that they act dissimilarly, and this dissimilar movement is studied using a correlation matrix or a correlation chart. So if something correlates at a high level, it's very much like that other thing, right? And in stocks, that means that they act similarly or they move in similar directions. So what we're looking for in this chart are low numbers here. You can see that the fixed income against all of the stock categories, 0.1. We're looking for something close to 0. We want them to correlate at a low level. When one's going up, the other's going down. That provides us a place to hide, right? When one is going down, we've got something going up. Well, even these numbers are pretty good correlation, 0.7, 0.68, 0.72. We know which asset classes move dissimilarly one from another. And we engineer the portfolio to take advantage of those dissimilar, low correlating price movements. And for us to add a diversifier in, like emerging markets in 1996, it needed to have both of those benefits. It needed to have premium, a potential for premium gain, which they showed 40 years of or 35 years of, and needed to have correlating benefits acting dissimilarly from other price movements. Does it make sense? So before we add a diversifier or we bring something in like gold, we need to know that there's a premium involved to it. We need to understand the definition of market timing, and that market timing is a bad idea. Market timing is any attempt to alter the mix of assets in your portfolio based on a prediction about the future. Any attempt to do that whatsoever. Our tendency is not to do this, to get out at the top and get back in at the bottom. Advertisements right now, if you pay attention to the financial advertisements, Most of them are geared toward, if they're not actually saying these words, they're saying, aren't you ready to get back in? Right? Even there's an advertisement, I can't remember which one it is. They're saying, for those of you who are ready now to get back in. Well, what if you had waited till now to get back in? And you had gotten out at some point from 2008, 2009, or 2011 when it went down. You would have lost out on most of the rebound, really all of the rebound. And that's what our nature is telling us to do. That's what our instincts tell us to do. They don't help us do this. And even if we get it right once, how many times over even a short-term period that the stock market would require you to get it right? If that's really what the game we're going to try to play, how many good decisions do you have to make? You have to make good decisions over and over again, and the likelihood is that you won't. And then 4, know where returns come from. Returns come from asset allocation. The best analogy I can use for this chart is the freshman who comes to their class for the first time and they get the syllabus. And usually on the syllabus, I haven't been to college in a while, where they show you the breakout of where your grade comes from, right? This amount of your grade comes from your attendance, this amount of your grade comes from the final exam, this amount of your grade comes from your paper, whatever. And those classes that have a low percentage of your grade coming from attendance is usually not a very well-attended course for freshmen, including especially the 8 o'clock class, right? Well, that's kind of like this chart. This chart has shows that asset allocation is the #1 and highest predictor of your ability to gain returns. Stock picking, other factors, market timing, those will not contribute to a positive return for you over time, but asset allocation is where it's at. So we say, where does return come from? Return comes from the market, not from managers who try to beat the market, and return premiums come from those sectors of the market acting dissimilarly over time to produce premiums for you inside your portfolio. So real quickly, the top 10 ways you know that you're about to jump into a popping bubble, okay? Number 1, if everybody's talking about it, if it's popular, if it's on Kudlow, if it's on Kramer, probably you want to stay away from it. It's a bubble. If it's cool, it's probably a bubble. If it's on the cover of a magazine, how to invest in the hottest market ever. Oh, these are ever. How the best market ever. This is so great. There's a magazine cover you're never going to see. You're never going to see a magazine cover with my picture on it that says, investment advisor successfully coaches 1,000 investors over 4 decades to remain disciplined and capture market premiums and rebalance on the highs and lows. That does not sell a $4 magazine. It really doesn't. Pardon? Boring. It is not sexy. And if it's on a cover of a magazine, it is probably a bubble. I'm sorry to have to do this to some of you. If there are endless commercials on Glenn Beck, it is probably a bubble, okay? You can like Glenn Beck if you want, but probably buying what he's selling on his infomercials or commercials, whatever you call them these days, it's probably not a good idea. If it's the place to be, the herd mentality, where do we feel safe? We feel safe right in the middle of that, right? We feel safe if we're that guy. If we're all going to die, at least I'm going to die along with all kinds of other sheep. But it's probably a bubble if it's the place to be. If it has 3 to 5 years of unbelievable returns, we talked about that already, it's probably a bubble. If every financial advisor is talking about adding it as a new diversifier, it's probably a bubble. These are the core and explore model. That's the new phrase for market timing right now. You've probably seen it on your 401k statement, the core and explore group of funds that you can use. These are not proven most of the time. You remember we talked about the emerging markets sector that we added in 1996 after years and years of study, after lots of correlation charts were done. You can add a new diversifier, but it's not very often that you have the information with which to do it, so stay away from it. It generally is not going to be true. I'm going to turn this thing off in a minute if I keep squeaking you. If it has a popular story attached to it, maybe it's because I stand too close. I'll walk back here a little bit. Is it that one right there? I'll stand right here in front of that light. That would be perfect if that light was the only safe place. Nice. Okay, the food was great, but we got to work on the audio. If it has a popular story attached to it, here's the gold story in a nutshell, right? If we see what the government is doing with our debt, and they're printing money to make it happen, They're going to have to inflate their way out of this problem. So the government doesn't mind inflation. In fact, they like it. They like 3 to 5% inflation. It reduces the cost of paying off the debt to them. So if they inflate the economy with more dollars, that devalues the dollar. And so gold is going to be the safe place for your money. Gold has value if the dollar goes to nothing. That's the story about gold, right? So if it has a nice story to go with it, if it kind of sounds nice, it's probably a bubble. Gold has no expected return. It has had a good short-term run, but gold has the expected return of inflation, or T-bills, over 70, 80 years. There's no expected premiums to be paid in gold, and yet it has a great story, and many will look back on the last 10 years and wish they hadn't bought on the way up that hill. If there's a dummy's guide to it, it's probably a bubble. And if there's an infomercial about it, it's probably also a bubble. It's another thing you're probably never going to see is an infomercial by Evan Vanderway, with a group of you in the crowd yelling and screaming at me. Hey, rebalance, right? This is Mark Madsen. He's the owner and founder of Madsen Money. And again, another magazine cover you'll never see. How a globally diversified portfolio based on modern portfolio theory and efficient market theory and the three-factor model, combined with lifelong discipline and coaching, delivers strong, steady returns, vastly superior to the Dalbar numbers. Oh, and by the way, the 20 must-answer questions for peace of mind as an investor. That is not going to sell Money Magazine very heavily. Most people are not going to go ahead and buy that. But isn't it true of just about anything? The book you need about investing is not something that has to come out with a new edition every month. I mean, it's not necessary. This information is just not changing. We don't get paid to chase bubbles. We get paid to coach you to avoid them and to rebalance. Bubbles equal severe volatility. We don't mind volatility. People ask me all the time, can you get rid of all the volatility? Well, we probably can with a fixed income product, but I don't think you want that necessarily. We need some volatility. There's a cost of capital story here that you won't get more than inflation's rate of return if you remove all risk. You want some risk. And I tell folks who are looking to buy that annuity for guarantees that, hey, the other side of that guarantee coin is that you're guaranteed never to have a return that exceeds inflation. And so you're guaranteed your money will never grow in value greater than the cost of the goods you want to buy. So we want volatility in our portfolios, but we'd like to avoid severe volatility wherever we can. And even where there is real volatility, if I can counter it with asset classes that counter move and have low correlation, we want to do that. Bubbles create the delusion of safety. We feel like it can't go down. There's a general consensus, this herding. And rebalancing, again, is to investing as eating less and moving more is to weight loss. So there's a formula to this and an academic way to do it. And there are the 3 C's, and this is really where the dinner is buying your brain cells here right now. So stick with me because this is not exciting, but it's important for you to be a good investor, okay? So here's our conscience, right? Jiminy Cricket is the conscience of the day. And conscience, the 3 C's of investing, one is conscience, the inner sense of what is right or wrong in one's conducts or motives. The complex of ethical and moral principles that controls or inhibits the actions or thoughts of individuals. And an inhibiting sense of what is prudent. That's conscience, and conscience is important to investing. We have conscious. We want to be conscious, not brain dead, aware of one's own existence, sensations, thoughts, surroundings, fully, there's another one, my goodness. Good speakers. Fully aware or sensitive to something, known to oneself, felt, conscious guilt, aware of what one is doing, deliberate, intentional, acutely aware, or concerned about. Last C is caution, alertness and prudence in a hazardous situation, a warning against danger or evil, anything serving as a warning, a person or thing that astonishes or causes mild apprehension.